Okay, so what we need to point out is when you're doing these problems, make sure you know whether you're periodic or perpetual. And right here it's saying periodic. So that's key. We're going to have a different set of accounts. Okay? So it says journalize the following transactions for Moody bicycles using the periodic inventory system. Explanations are not required. That means you don't have to put that little memo in there at the end. So I got a bunch of transactions. Not a whole lot. What do we got? 7 of them? Okay. So the first transaction, we purchased $3,300 of merchandise inventory on account, and they're giving us these terms. We don't have to have this up. Okay. 3% if we pay in 10, otherwise all of it is due by the end of the month. So we're going to book a debit to purchases. Almost caught me there, right? Remember, perpetual system you can book directly to inventory. In the periodic system, you can't touch inventory when you're making journal entries. Okay? Because inventory is an amount we figure out at the end of the period when we count inventory. So we're going to not touch that account because we don't want to mess it up. The last amount we have in that inventory account is from the prior period end. So when the next period end comes around, we're going to count it. Okay. So in the interim there, we have to use these other accounts to keep track of stuff. So we're keeping track of what we purchased during this accounting period. We're keeping track of that separately in an account, especially for purchases, called purchases. Okay? And we did it on account, so we're going to have an accounts payable 3,300. Okay? So if this were the perpetual system, I wouldn't have used the purchases account. I would have booked it straight to inventory, straight to merchandise inventory. Okay? I got fantastic this time. You guys got fantastic? Okay. Now remember, when we return something, right, in the periodic system, we cannot touch inventory. We cannot put it into inventory. We got to put it into an account called purchase returns and allowances. So we're going to reduce what we owe because we're returning it, right? We returned $900 worth of inventory, so we're going to stick that. We're going to reduce the accounts payable because we haven't paid for it yet, right? So we're going to reduce the amount we owe, and then we're going to put that reduction in this purchase returns and allowances account. Okay? We keep track of everything separately now, right? It doesn't touch inventory. Okay? This is a good problem to go over. Okay. Now remember, when we bought something in the perpetual system, we booked it directly. When we paid for the freight on the stuff we bought, we booked it directly to inventory. In the periodic system, we can't do that. We have to have a separate account. So we're going to call it the freight in account. Right? And because we paid, we've got cash.
Oh, so if they say the hairdress freight bill, you have to put it in the freight in.
In the periodic system, you put it in freight in. But remember, that freight cost really is part of the cost of the items you bought. So in the perpetual system, because we can use the inventory account, we book it directly to the inventory account, the freight cost. Yeah. Okay. We sold merchandise inventory on account 6,500, and we give them terms 3% and 15, net 45. Okay. This entry will be the same. The sales piece will be the same in both perpetual and periodic. The sales piece. Now remember, in perpetual, we're able to recognize cost of goods sold. In the periodic system, we can't make an entry for cost of goods sold. So we're only going to really do half of what we do in perpetual. Okay. So this was on account. It's going to be debit accounts receivable and credit sales revenue. 6,500. Okay? Now it says paid amount owed on credit purchase of November 2nd, less the return and the discount. So, you know how I am, yeah? I know a lot of you can do this thing in your head and you can get it accurate. But I kind of know from experience that I really like to just make a T account. We're going to call it accounts payable. And we're going to go back up. Let me make this smaller. We can have this side by side, yeah. We're going to go back up and we're going to look at everything that happened with that November 2nd purchase. So notice, November 2nd, we increased accounts payable by 3,300, right? That's the November 2nd. Okay, right here. And then we returned some, so accounts payable went down by 900. And that happened on November 6th. Okay? And it's a small enough problem where you could do it in your head, but I like to break it down. You know, we're going to take the time to show you what's going on. Now, remember the credit terms. It says 3% if paid in 10 days. So it looked like this, 3 and 10. So 10 days from November 2nd. We want to double check. We want to make sure we're, looks like we made it within 10 days because it's November 11th, right? Not November 12th. So we're going to get that 3%. What's the balance in the account at the time of payment? 3,300 minus 900, right? This is the balance. So we're going to figure the 3%. So you're going to take 3% times 2,400, and that'll be what we call our discount. Am I losing anyone on this? Be honest if you don't understand these credit terms. When you go 3/10, that means 3% discount if paid in 10 days. And in this case, they say the total, which is N, is due by the end of the month. EOM is end of the month, okay? So that's going to be the discount, if I can spell it correctly, okay? And then remember the balance is 2,400. If you subtract the discount, so 2,400 minus discount, that's going to be the payment amount. That's the payment that's going to be received or paid, right? That's what we're going to pay. Okay? So when you do this, when you pay within the discount period, you're going to go ahead and relieve the accounts payable for the full amount. So 2,400 is going to go away because we're basically paying it off. Okay. Now, the discount amount is going to go to an account called purchase discounts. Okay. If we were doing the perpetual system, we would have labeled this directly to merchandise inventory. Okay. But we're in the periodic system and we cannot touch merchandise inventory, so we have to put it in a purchase discounts account. So $72, which is 3% of the 2,400, purchase discounts, and then whatever is left over, the difference, which I figured out over here, is going to be the cash payment. So 2,328 is the amount that we pay to relieve 2,400 in debt. Okay? Because we paid within 10 days, we get a discount. Why would a company offer such a discount?
They get the money faster.
Get the money faster, right? It's almost the same as accepting credit card, because you know when a business accepts credit card, they have to pay the credit card company. American Express is almost 4%. Then like MasterCard, Visa, it's down in like the 2.3 range, if it's still the same. So it's a way to get your cash flow. You know, you're running a business, cash is what you need. You get your cash in faster. You offer a discount. Okay. Let's see if this works. Excellent. Okay. Are you able to see the difference now? I mean, we did perpetual the other day. Are you kind of getting more clear on the difference in the accounts that we use between perpetual and periodic? Non-responsive. Okay. I'm going to assume that it's yes. Okay. When in doubt, it's yes. Okay. Now we granted a sales allowance, so we're giving the customer a credit. Okay. Maybe they're a good customer. That's going to go to sales returns and allowances, and we're going to reduce the amount that the customer owes us. So 200. That's the November 10 sale. You want to go up here and look at November 10. Just eyeball it, right? So we reduce the accounts receivable by 200. Now that, when it comes to sales, we do it the same way, both periodic and perpetual. It's just the purchases and the inventory related things that are different. Okay? This is going to be the same entry if you were in perpetual, when you're on the sales side of things. Okay? Now we receive cash from the November 10 customer in full settlement of their debt, less the sales allowance and the discount. So, you know, ideally you would set yourself up a T account again, kind of like what we had here. And we'd call that one accounts receivable. Okay, so on November 10th, it went up by 6,500. Right, that was the November. Notice I'm accounts receivable now. I'm not accounts payable, so that's debit balance, right? And then when we reduced it, right, we reduced it with a credit over here, 200. So that's November 15th. Okay. And you guys are wondering, why does this guy have to make this T for every little thing we do? Well, in reality, you might have 1,000 things going on in one T, right? So you kind of want to get in the habit of working with a T or some other way where you can keep that running total going or keep that tally up, right? So the balance that they're going to be paying off is 6,300. I might skip a couple lines and stick that in there. Accounts receivable of 6,300 is going to go away. Okay. Now we also want to look at the credit terms we gave them. We gave them 3% if they pay in 15 days. So from November 10 to November 22nd, it's within 15 days. Okay, so I'm going to give them 3%. So I got 3% times 6,300, and that's going to be my the sales discount amount. Okay, so that's your sales discount. Okay, and if you take the 6,300, that's the accounts receivable balance, and then the payment that's to be received will be the difference between 6,300 and $189. Okay, so we already booked the 6,300 in. The customer no longer owes 6,300. We're going to receive cash of 6,111. That's what the customer cut the check for. Okay, and then the difference to make the whole entry balance will be to sales discounts, which is a contra revenue account, meaning it works in the opposite manner of revenue. Sales is a revenue account. Works in the opposite manner, so it increases with a debit. Yeah? Whereas sales increases with a credit. So remember, if you think about the other problem that we did, right? When we did our multi-step income statement, we showed sales. We did it like this, right? Sales revenue, and then we had less, and we had sales discounts, and sales returns, and allowances. Right? And then when we got down to the bottom, we had net sales. So that's the way you present it. Does it make sense?
Yeah.
Okay.
Yeah,
All right. Well, I'll put this up there too. So.
So you don't have the purchase for the sales returns and allowances on there?
They didn't give me one where we had a sales, yeah, right here. See sales returns and allowances?
But it's not on the chart.
That's it.
We did an entry with that here. See?
Okay.
I don't understand the question though.
But it's not, like, you just have sales discounts on that final one.
Well, this one was a discount. The return was taken care of in the prior step. You see what I mean? They returned the 200 on the 15th, and then they made the payment on the 22nd, right? So look at this, Spencer, right? What I did was I figured out what my balance was first, and my balance started at 65, but this is the return. So that brought the balance down to 63. We only computed the discount on the balance minus the return. So that's why I did this, right? Right? The balance minus the return is 63. So we computed the 3% discount on 63, not on 65. Because they don't owe 65, they owe 63. Right? And then after the discount, they only owe 611. 661.
But the sales allowance of $200, that's not reflected in that final chart.
Final chart that I'm making over here.
No, on the left. Yeah, like.
Is there a chart? This is a journal entry.
Yeah, the journal entry.
It doesn't need to be, because it was taken care of over here. You see, the previous journal entry took care of the $200 sales allowance, right? You see what I'm saying? Yeah. On the 22nd, it's the discount that we're taking care of. But in this case, the way we would list it is, we would have our sales revenue of 65, and then it would be less the sales discount of 189, less 200 in sales returns and allowances. So your net sales would show as 65 minus, right, 611 would be your net sales. And then whatever your cost of goods sold is, so maybe you have cost of goods sold, why don't we put this, move this guy out here. Yeah. You might have cost of goods sold. I'm just making that up for now, but maybe you had $3,000 in cost of goods sold. So now you would have a gross profit of the difference between your net sales and your cost of goods sold. That would be your gross profit. Kind of tying it into the previous problem. And then your gross profit percentage would be, take your gross profit and divide it by your net sales. So that would be a 50, almost a 51% gross profit percentage.